Welcome to Deloitte's Debriefs Tax Webcast series in Asia Pacific. Our webcast today is from our Geography Update series and is titled Virtual Digital Assets, Goods and Service Tax Issues in India. My name is Hardik Gandhi and I'm a tax partner based in Deloitte, India. I have the pleasure of hosting today's webcast. I also have my colleague speaker with me today, Shilpi Chaturvedi. Shilpi is a tax director and she is also based in Deloitte, India. She specializes in TMT and in particular taxation of virtual digital assets. You may access our bios on the left side of the screen. Now, before I introduce the agenda for today's webcast, I would like to take the moment to highlight some of the features of our webcast console. First, all users are on listen mode only. If you have any content-related questions, you can submit at any time in the Q&A box at the bottom right of the screen. We will do our best to respond to your questions during the presentation. Second, all PC users can maximize or minimize each box at your convenience during the webcast. You may also explore the icons at the bottom of the screen. If you want to download today's slides and related publications, please go to the downloads and the links box. On the other hand, mobile device users can view the slides and answer the survey on the screen. Lastly, if you require an attendance record for this event, you will receive an automated email with CPE certificate after watching for 50 minutes. Now, let me give you an overview of the topics that we are going to cover today. First, we will walk you through the landscape of the virtual digital assets in India. After that, we will discuss the classification of the virtual digital assets as goods or services from the Indian goods and service tax standpoint. And we will go on to discuss some of the concerns around the tax treatment of these transactions, and in particular, the cross-border transactions. Interestingly, we will also try and cover some of the nuances of the transactions happening in the metaverse and the tax issues around the same. Secondly, we will also cover the GST issues on transactions happening in the metaverse. This will be followed by question and answers at the end of the session. We hope you find the session interesting. I now hand over to Shilpi to take the session forward. Thank you.
Thank you, Hardik. Hello, everyone. Happy New Year. I'm Shilpi Chaturvedi. I'm a director in the indirect tax practice at Deloitte, India. Thank you, everyone, for joining the session. Cryptocurrencies, NFTs, and metaverse have been the buzzword in India last year. As per United Nations Conference on Trade and Development Report 2021, more than 7% of Indian population owns digital currency, which is a significant number. At present, there are no official law or regulation that restrict an Indian resident from buying or selling of VDAs. However, in order to protect consumer interest in light of the aggressive advertisement of virtual digital assets in India, the Advertising Standard Council of India, also known as ASCI, which is India's self-regulating body for advertising, has issued certain guidelines to be followed for all advertisement released or published across all mediums. Let us now have a look at the journey of virtual digital assets in India. It was way back in 2012 that Bitcoin and other cryptocurrencies gained traction in India and crypto exchanges starting making inroads and making their presence felt in India. Looking at the spike in the transactions, in December 2013, Reserve Bank of India issued a press release that cautioned the users, holders, and traders of virtual currencies that it has not issued any license, authorization to operate or deal in virtual currencies. Thereafter, in April 18, RBI, the Reserve Bank of India, issued a circular prohibiting commercial and cooperative banks, payment banks, small finance banks, NBFCs, and payment system providers for currencies and instructed the regulated entities to exit the relationship within 3 months. Post this, crypto exchanges were unable to access the banking systems in India. The matter reached the apex court in India, and in March 2020, the Supreme Court struck down RBI's ban on virtual currencies and held that circular issued in April 18 was unconstitutional. In the Union Budget for 2022 and 23, the Indian government took the first step on the clarity on taxation of virtual digital assets such as cryptocurrencies and NFTs from a direct tax perspective. However, clarity on legality of virtual digital assets from a regulatory perspective is still awaited by the industry. In early 2022, it was announced by the Indian Finance Minister that the Reserve Bank of India will introduce the Central Bank Digital Currency (CBDC) as India's official digital rupee in 2022 and 23. We are yet to receive official introduction on this. Thus, the Indian government has clarified its intention to keep the CBDC distinct from any private cryptocurrency. The cryptocurrency and creation of official digital currency bill for discussion in the parliament soon. Indian government is working towards bringing clarity in the VDA industry from a regulatory perspective. I now hand over to Hardik for taking a poll question.
Thank you. I think the polling question is, are there any laws in your country relating to virtual digital assets from a regulatory standpoint? Yes, no, and work in progress. You may start the poll now, and then we will view the results. I think the result looks to be kind of divided, whereby 30% of the answers are yes, there are regulations in their country governing virtual digital assets. About 40%, close to 40%, are of the view that there are no regulations governing virtual digital assets such as cryptocurrencies and NFTs, and almost 31% uh, say that the regulations are work in progress. So, which is a fair poll because looking at the nuances of virtual digital assets such as cryptocurrency and NFTs, framing a regulation is seemingly a difficult and a daunting task, and it goes to it. And at the moment, it seems that things are more or less work in progress. So, over to you, Shilpi, for taking this forward. Thank you.
Before discussing the taxation aspect related to virtual digital assets, I would like to spend some time in understanding some of the common terms used in the ecosystem. For tax purposes, the term virtual digital asset has been defined as any information or code or number or token generated through cryptographic means which represents value exchange or has inherent value or function as a store of value or unit of account. This can be stored, transferred, or traded electronically. Any currency, whether Indian or foreign, is not covered within the ambit of virtual digital asset for tax purposes. As you can see, the definition is very wide. In common parlance, virtual digital assets can be classified into fungible and non fungible tokens. Now, fungible tokens are interchangeable and non unique. Fungible tokens are broadly classified into three categories: payment tokens, security tokens, and utility tokens. Let us now look at what do these each of one of them signify. Payment tokens are the tokens which are a means of payment for goods or services. Globally, most regulators are of the view that payment tokens cannot be assimilated with fiat currency because they are not used or backed by the central bank. Their value solely depends on the trust or the value that user places in them. Classic example is cryptocurrencies such as Bitcoin or Ethereum. Security tokens are the tokens which are provided to the holder the ownership of asset and entitlement to use them. Such tokens are more similar to financial instruments such as stocks, bonds, etc., rather than to the mode of payment. Utility tokens provide token holder with access to a function, use, or participation in an event, service, or product. In some aspects, such tokens are akin to a voucher. Non-fungible tokens or NFTs are unique and irreplaceable. Each token is uniquely identifiable and is backed by a digital asset. They are rare collectibles, interesting art pieces, music, video, and in-game products or similar digital content that can be bought and sold on the NFT marketplace. NFT claims to provide a public certificate of authenticity, but the legal right conveyed by the NFT depends on the smart contract embedded into the NFT. We will now move to briefly discuss the direct tax landscape in India on virtual digital asset. Please move to the next slide. Income from transfer of any virtual digital asset is taxed at 30% in India with effect from 1st April 22, 2022. This will also there'll be a levy of surcharge and cess as well. This taxability does not have any bearing on the question of legality of virtual digital assets in India. The term virtual digital asset, as we've seen, has been defined in a very broad manner. While the term includes both fungible and non-fungible tokens, the government has the liberty to notify other digital assets to be included in this definition. Post discussion with the industry and commerce, government in June 2022 specifically excluded the following from the definition of virtual digital assets: gift cards or vouchers, mileage points, reward points or loyalty cards, subscription to websites and platform or application, NFTs whose transfer results in legally enforceable transfer of ownership of underlying tangible assets. Further, there are various restrictions imposed while computing the taxable income, such as no deduction allowed on any expenditure other than cost of acquisition or allowance or in setting off of any loss. Set off of losses incurred on transfer of VDA against any other income is not permitted. Carry forward of such losses to subsequent year is also not permitted. With this, we can see that the government has tried to discourage people for investing and giving them extra benefit on how to compute the taxable income. The additional gifting of virtual digital additionally, gifting of virtual digital assets is also has been made taxable. Further, from 1st July 2022, transfer of virtual digital assets on the payment of consideration to a resident also be subject to a withholding of 1%. We will now move to discuss some of the key aspects related to VDA from GST perspective. Please move to the next slide. There are various challenges related to virtual digital assets from a GST perspective as well. As on date, no guidance has been issued by the government on taxation of virtual digital assets. However, post the introduction of income tax on virtual digital assets, the Central Board of Indirect Taxes and Customs, also known as CBIC, informed that it has set up an internal committee to examine the taxability of VDAs from an indirect tax perspective. However, the committee is yet to publish its recommendations or suggestions on taxabilities of VDA in India. Based on information available in the public domain, we understand that the GST intelligence authorities have either started investigations or issued inquiry emails or letters to both Indian residents as well as foreign companies to gather information related to their business transactions involving VDAs within or from India. While there is no clear guidance on the taxability from the indirect tax perspective, VDA is on the focus of the Indian tax authorities. One of the core issues under GST is the characterization of virtual digital assets in the traditional definition of the law. And if it is held to be taxable, then where does the situs to discharge the GST liability lies? We will now discuss the issue of characterization of VDA in greater detail. Fundamentally, GST is applicable on a transaction of either goods or services. If a particular supply does not fall within the definition of goods or services, then the liability to discharge GST does not arise in India. In case the transactions fall within the contours of the definition, Then the next level of aspects, such as what is the place of supply, does it fall under any specific exemptions or the exclusion, etc., need to be evaluated. The definition of goods under GST is defined to mean any kind of movable property. The definition excludes money and securities and includes actionable claims. While we will discuss the technical definition in greater detail, the basic characteristics of goods includes that it should be capable of being bought and sold, and should be capable of being delivered, stored, and transferred. It is pertinent to note that both tangible and intangibles are included in the definition of goods. Money, which is excluded from the definition of goods, means Indian legal tender, foreign currency, or any instrument recognized by the Reserve Bank of India, such as pay order, check, etc. It is important to note that Reserve Bank of India is India's central bank and regulatory body responsible for regulating the Indian banking system. So if RBI does not provide sanctity to any instrument in India, then it does not qualify within the definition of money for tax purposes. Given that RBI has not provided legal sanctity to virtual digital assets in India, it does not qualify as money. Now, the definition of securities under GST is borrowed from the Securities Contract Act of 1956, where the term has been defined to include shares, scrip, stocks, bond, debenture, and other marketable securities of a like nature. One of the key aspects of security is that there should be two parties, one the issuer and the other a subscriber. The security denotes the right the subscriber has over the issuer in the underlying asset. In the context of VDA, virtual digital assets are created by miners, and in most of the cases, there is no underlying assets. It seems that basic tenets of the principle to qualify as securities are not met in the case of VDAs. So, going back to the definition, if we see, goods mean any kind of movable property. It excludes monies and securities, but includes actionable claim. So then now we move to understanding what the actionable claims represent. Though the definition of goods include actionable claims, transaction or activities in actionable claims are kept outside the ambit of GST except for lottery, betting, and gambling. So only limited, which means lottery, betting, and gambling, are the only three actionable claims which are taxable right now in India. And VDAs do not seem to be covering under any of these three. Further, all actionable claims other than lottery, betting, and gambling are neither considered as supply of goods or services, which means that VDAs are neither considered as goods or services if we were to go down the route that VDAs qualify as actionable claims in India. Thus, it is very tricky to understand that virtual digital assets, if they were to be qualifying as goods, they need to qualify as part of the main definition that it should be a movable property. It appears that VDAs do not get covered under the actionable claim as there is no debt involved and there is no beneficial interest in any kind of movable property. The last definition to consider is of the term service. Under GST, service is defined very widely to mean anything which is not a good, is a service. So, and money and security logically have been excluded from this definition as well. It is pertinent to note that from NFT perspective, while temporary transfer or permitting the use of intellectual property is considered as a services, the permanent transfer of such right is considered as a good. So there is a little bit of ambiguity on the way or the nature of the transaction, the way it is executed, in identifying whether it qualifies as a good or a service in case. Thus, when one analyzes whether VDA in light of the definition of the tax definition discussed, it seems that VDAs are capable of being stored and transferred. Thus, one thought that VDAs are more akin to the classification of goods. However, for NFTs, one need to understand the nature of the underlying asset and the right before analyzing whether it is goods or services. The next aspect to be considered is the status of the transaction. The basic principle for GST applicability is the place of supply should be in India. Given that India has adopted the dual GST model, determining the status of the transaction, it is important in order to identify the transaction is interstate or intrastate as well. The law provides the principles to identify the place of supply or the consumption of the transaction. For example, the location of immovable property is considered to the place where the supply relating to immovable property is provided. Generally, in banking, the location of the customer is considered to be the place of supply. Exceptions to this rule as well. Additionally, the key parameter to determine the status has been the location where the movement of good commences. In case where there was no movement involved, the location of the good at the time of transfer is considered as the place of supply. In case of services, the place of consumption is held to be the location of recipient of the service, barring a few exceptional cases. In case of intangibles, some of the legal precedents indicate that the place of supply should be the place where the agreement is signed. If we go back and apply these principles to a VDA transaction, the characterization of VDA into goods and services will have a direct bearing on the method to determine the status of the transaction. Please move to the next slide. In addition to the questions of characterization and status, one also needs to answer the following questions in order to determine the taxability of transaction. Where is the location of the supplier and the receiver? Is the supply for furtherance of business? And if the supply is, then was the supply made for a consideration? Let us now look at the key players in the crypto ecosystem and the typical transactions that undergo here. I think, wait for the polling question to be closed.
Sure, Shilpi. So it seems that the majority of the responses from the participants is that, look, there doesn't appear to be any specific provisions under the GST law of the respective country on with respect to taxation of virtual digital assets. So I think it will take time for the law to evolve. Again, given the nuances and the finer aspects of whether it's a supply of goods or supply of services, and what are particularly for, and the law would also differ based on the nature of the virtual digital assets, particularly from GST perspective. It could be different from crypto assets. For NFTs, again, whether there is an underlying tangible assets being delivered under a smart contract or any other transactions which happen using the technology of the blockchain. So good number of the responses are that yes, there is no law, and whether it's goods or services, there is still an open question to be answered. So that's about it on the polling question. So over to you, Shilpi.
Thanks, Hardik. In addition to the question of characterization and status, one also needs to answer the following questions in order to determine the taxability of the transaction. Where is the location of the supplier and the receiver? Is the supply being made for furtherance of business, and is the supply for a consideration? Let us look at the key players in the crypto ecosystem and typical transaction. The first key player is the miner. The mining means an activity aimed at creating a virtual digital asset such as cryptocurrency and or validating a transaction of cryptocurrency between the buyer and seller of cryptocurrency. Generally, miner creates a cryptocurrency without having any obligation casted upon him or her by any other. It is more likely that this will not be for furtherance of any business. There is no identified receiver for which the miner undertakes the mining process. Though there is a consideration in form of cryptocurrency involved, It is challenging to say that the process of mining has been undertaken in furtherance of business and is in form of consideration in money form. The second key player is the exchange. Cryptocurrency exchanges are online platforms designed to facilitate trading. There are centralized exchanges which make money through commission and transaction fees. Also, there are decentralized exchanges which allow peer to peer transactions directly from your digital wallet without going through the intermediary. The decentralized exchanges do not require customers to fill out Know Your Customer forms, offering privacy and anonymity to users. Thus, this brings us to other relevant player, which is the seller and the buyer. Given the anonymity and the trust and the fact that the trust is the key to the entire ecosystem, it is becoming extremely challenging for the tax authorities to identify the location of the seller and the buyer. Logically, the governments went towards and asked for information from crypto exchanges about the nature of the transactions and who are the ones who are undertaking these transactions on the platform. Given the fact around anonymity, the crypto exchanges also did not have too much information available with them because that is not, uh, collected as part of the normal process. Or in case where they had the information, it was incomplete for any tax authorities to identify the exact location in terms of the traditional way of identifying the location, which is like a complete address on a street or a building number. Now, generally, in order to understand the nature of the transaction, one would rely on the agreement executed between the parties. VDA transactions are executed through a smart contracts whose legality and enforceability is yet to be tested before the courts. The exchange may not know or may not have the right amount of information for tax purposes regarding a VDA transaction executed on its platforms. Though these exchanges are discharging due taxes on the transaction fee that they charge or the platform fee they charge, but they do not have or they are of less help to the tax authorities to provide the right information of the actual transaction which has occurred on their platform. Thus, these are difficult questions before the lawmakers for determining the GST applicability on purchase and sale of VDAs. Some of the other key challenges are the nature on which the tax on the are the value on which the tax is to be levied. While in case of NFTs, one may consider the value of the underlying asset, but in case cryptocurrencies, the transaction is likely to qualify as barter in the traditional definitions of the law, and the value of the crypto needs to be identified each time it is traded for tax purposes. Thus, it is important that the complete clarity is provided by the government on the valuation of VDAs for GST purposes so that ambiguity is removed and litigation and disputes with tax authorities could be mitigated. Further, other operational challenges such as issuance of a tax compliant invoice also needs to be looked into. From the government standpoint, some of the options that could be considered for bringing industry under GST ambit could be for B2B supplies implementing a reverse charge mechanism. For e-commerce platforms, extension of VDA exchanges in the TCS provisions where 1% TCS is to be paid by the exchange in respect of the VDA transaction executed through its platform. For a B2C supply, government could explore extending the OIDA related provisions and bringing the industry into the ambit of tax in India. Next slide, please. We now move to understand some of the transactions and the tax implications which are there happening in the metaverse. Metaverse often described as the future of the internet as and has undoubtedly garnered a lot of attention recently. Metaverse is a virtual shared space that represents the ultimate convergence of digital and physical reality. Imagine a virtual world in which people live, work, shop, and interact with each other, and all from the comfort of their couches. While some companies are looking at metaverse as an innovative and exciting way to engage with customers, others are aiming to drive commerce in metaverse. Metaverse is projected to be a fully functional economy in the coming years. It will be interpolable, and information will move seamlessly across platforms 24/7. Thus, the lawmakers need to gear up and develop a global harmonized approach in regulating digital assets and related transactions in metaverse. Taxation in the metaverse is a complex and emerging topic. Given that the transactions would happen in a virtual world, it brings another set of complexities relating to the jurisdiction, that is, who will collect the tax on such transactions. In the digital world, since there are no physical borders, it is hard to trace where the transaction takes place and who would actually collect the tax. Though metaverse is termed as an immersive virtual world, school of thought from tax perspective that is emerging is that metaverse is an immersive video game which could be hosted on a server, and thus the location of the services or goods sold would be critical. Sorry, the location of the server would be critical to determine its jurisdiction. Few transactions that would be prominent in metaverse are a sale of virtual metaverse. One can buy a piece of land just has a unique address attached to it, which some believe make it akin to an NFT. The next transaction will be dependent on what is the owner of this virtual land. The owner can and further sublet to merchandisers, build a house, host films, or events. This is anybody's guess. The second kind of transactions that will happen are permanent objects and services. In other words, one can procure different goods and services such as cars, sneakers, clothes, just like in the real world. The third category is hosting of an event. Different type of events such as music concerts, team meetings, virtual sessions can also be in any part of the world to attend such events. But one question to answer is, where is metaverse located? Another question is, how would the tax compliances be undertaken for the business transactions happening in this metaverse? How will the global parity be achieved in terms of how the invoice would look like? Which country's rate of tax to be followed? How would the tax reporting happening for a transaction occurred in metaverse be reported in the physical world? How the input tax credit flow will flow in the supply chain. One school believes that virtual transactions would be akin to non-fungible tokens. Thus, the issues relating to classification, place of supply, barter discussed earlier would be applicable to transactions in metaverse as well. The chairman of Central Board of Indirect Taxes in India has more than one aspects of cryptocurrency and virtual digital assets that require detailed examination from GST perspective. He mentioned that CBIC is in the process of examining these aspects and there will be some finality in due course. In the global forum, OECD is in the process of potentially creating a common crypto tax framework in an attempt to gain consensus among jurisdictions.
I'm sorry, the network looks to be patchy from Shilpi.
Oh,
Shilpi, are you there? Okay. Looks like the network is slightly patchy. So we will come on the topic of disclosure requirements for virtual digital assets. And some of these aspects we have covered over here is that in March 2022, the OECD published a public consultation document outlining a framework for reporting and exchange of information on digital asset activity. And thereafter, the US Treasury also released proposals in the financial year 2023 called as Green Book that included a proposal that effectively brings digital assets into the scope of Foreign Account Tax Compliance Act, which is FATCA reporting. Thereafter, in October 2022, OECD issued the final crypto asset reporting framework called as CARF and the Common Reporting Standard CRS, update guidelines. In India, the Ministry of Corporate Affairs, which is MCA, has amended the Schedule 3 of the Companies Act, effective from 1st of April 2021, that requires the companies to disclose the details of crypto or the virtual currency in their financial statements. Now, when the company has traded or invested in the crypto or virtual currency during the financial year, the following information is required to be disclosed in the financial statements. One is the profit or loss on the transactions involving cryptocurrency or virtual currency, the amount of the currency held at the reporting date, deposits or advances from any person for the purpose of trading or investing in cryptocurrency. However, uh, more importantly, from a GST standpoint, given the fact that we do not have so much of clarity as to whether it will be supply of goods or services, or what should be the place of supply, or what should be the jurisdiction where the tax should be paid, the clarity in terms of reporting under the GST is still awaited. Now, with the advent of technology, the world around us is changing at a rapid pace. And probably what we believe is a proactive approach from the GST lawmakers, a clarity in the policy through a global consensus are really important to help us adapt to such changes smoothly. It is also important that the lawmakers understands the nuances of the virtual digital assets and make the industry or the sector an important stakeholder when they make laws around the taxability on these transactions. So we are on the end of the session. So we will have some time for question and answers from the audience. So we will open the floor for Q&A. Thank you. Happy to take any questions on this topic. I think Shilpi is back. So Shilpi, would you like to cover something on the expectation from the budget and any other aspects around VDA?
Yeah. So, the Indian budget is to be announced shortly, and the industry is looking at this budget for having more clarity on the CBDC, which the government has announced in the last budget. That what is the outcome of that announcement, and when is it likely to be introduced in India? The second aspect that the industry is looking at is more clarity on from a GST perspective. The committee has been discussing this for quite some time, and if there is any recommendations that has been made, or where does the government stand of taxing the purchase and sale of VDAs, and what is the mechanism to do so? If there is any clarity on that, the industry is waiting for that with the looking for the budget for that. uh, we'll keep our eyes and ears open for the announcement made and be updating the audience about that. I hand it over to you, Hadik. Uh,
So Shilpi, there are some questions in the question box. Probably you can just
oh,
take it from there.
sure. Oh, I just have it. So the question is that RBI governor spoke in the press conference that VDS's unrecognized market bring financial crisis. If and what do we think about it? That's a consensus, or that's the apprehension that a lot of countries have, that it will bring in instability because there is, or they are still struggling to figure out how to regulate it. Uh, VDAs is one aspect of the blockchain or the Web 3.0 services, but as a technology, as a blockchain based technology and its user cases have far more greater benefits than anything. Currencies or NFTs is the more commercialized way of doing this, and I'm sure with healthy help of the industry and the lawmakers will find some way to regulate it so that it is not becomes a financial crisis or is hindrance to a national security. uh, if the OECD is also involved in it, there will be some consensus, some framework which will come out. May take a little bit of time, but it will be there. But blockchain as a technology has tremendous potential to make the world a much better place to be in. The second question is, how can you compare a stock market versus a VDA market? Stock market and media market, the primary difference continues to be the support of the government, is what we feel. And there are regulations to control the stock market, but really it is still at a very nascent stage. This is a new chapter for the world, and the way the stock market has grown with its nuances and its applicability over the years, the virtual digital market also will have to go through the journey of growth and regulations. Since we are seeing this in front of us happening, we will I think we will be key stakeholders and we'll be able to witness the entire change of the landscape in the coming years. Over to you, Hardik.
Sure, Shilpi, we'll wait for some more questions. Okay. Yeah, we'll wait for 30 seconds for any questions and probably then we can wrap up. All right. So, all right. So, I think we are at the end of the session and there are no more questions. So, just to summarize, I think we need a lot of clarity around the regulations from a tax point of view, at least from a GST point of view, as on the taxation of virtual digital assets such as cryptocurrencies, NFTs, and transactions happening in metaverse through blockchain. Particularly, there are challenges around whether these can be categorized as supply of goods or supply of services. What we understand is that most of the countries have recognized these transactions as supply of services and not as supply of goods. But at least from an Indian context, we see a lot of challenges because one school of thought from the tax authorities is to see this as intangible goods and therefore should be characterized as supply of services, supply of goods, and not as supply of services. So that is one important aspect that needs upfront clarity. Followed with is clarity on the place of supply and the jurisdiction to tax. And given the fact that there are transactions happening through digital wallet, and in some cases the transactions do not even happen through exchanges, they happen peer to peer, and it's a very tricky way to identify a person or identify a tax supplier or a seller or a buyer when these transactions are happening outside the exchanges through digital wallets. on a peer-to-peer basis. There are softwares, there is a technology whereby these transactions can be done through just by just sending it on a pen drive. So therefore, it's really difficult to track all of these kind of transactions happening outside the market. So overall, we will have to wait and see as to how the laws get evolved and how these transactions are getting captured from a tax point of view. So, uh, so this is all we have the time for. So Shilpi, thank you, and special thanks to all of you who are able to join us. We would like to encourage you to fill out the short survey that will pop up on your screen and tell us what do you think about today's program. If you joined us late, please note that this presentation will be archived for future viewing. If you feel that the others have benefit from this webcast, please share the webcast via share this icon or have them visit Debrief's website. We will respond to all the questions submitted during the webcast in a couple of weeks. Also, if you think of any other questions or comments later, please feel free to reach out either to me or our speakers. We will be more than happy to talk to you. Also, please don't forget to tune in to our next scheduled webcast from the Geography Updates on 17th of January, which is titled Investigations and Audits under GST, Strategizing and Preparing the Businesses. At last, from all of us at Deloitte, thank you for your participation in Deloitte Asia Pacific Tax Webcast today. Goodbye. Thank you.